Preferred stocks explained. Higher income, lower risk? Most investors have no idea that there's a completely legal way to collect monthly income checks. That's way safer than owning regular stocks. And yet almost nobody's doing it. I'm talking about preferred stocks. And by the end of this video, you'll know exactly whether they belong in your portfolio. Let me be straight with you. Preferred stocks sit in this weird middle ground between bonds and regular stocks. Most people don't understand them. Wall Street doesn't advertise them much. But the wealthy? They absolutely love them. Here's the thing. When you buy a regular stock from Apple or Microsoft through Fidelity or Robinhood, you're basically an owner. You hope the price goes up. You might get a tiny dividend. Your return depends on whether other investors want to buy your shares for more than you paid. Preferred stocks? Totally different game. When you own preferred shares, you get priority. If a company runs into trouble and has to pay out money, preferred shareholders get paid before common shareholders. That's huge. That's literally why they're called preferred. But here's the real reason people actually buy them. The dividend. Let me give you real numbers. Right now, you can buy preferred stock from Bank of America paying around 6.5% annually. Not 0.65%. Not 1.5%. 6.5%. Every single year. You can actually buy these through Fidelity or any major brokerage in literally 5 minutes. If you throw $10,000 into preferred stock, you're collecting roughly $650 a year. That's recurring income. That's the difference between eating ramen and actually having money for fun. Compare that to the S&P 500 average dividend yield right now, which is sitting around 1.2%. Same 10 grand gets you maybe $120 a year. Plus you're hoping the stock price doesn't crater. So why isn't everyone doing this? Because preferred stocks come with a specific trade-off that most people don't want. Ready? You basically give up upside for stability. When you own common stock in a company that explodes, like imagine you bought Amazon back in 2010, your investment goes absolutely insane. $10,000 could have turned into $3 million. That's not happening with preferred stock. You're capped. You get your 6 or 7% dividend. And that's it. The share price might wiggle around between $20 and $28. But you're not seeing life-changing gains. Here's what preferred stockholders actually care about. Safety and income. Think about your 401k or Roth IRA. You're probably throwing money at index funds hoping for 8 to 10% annual returns over 30 years. That's the growth play. You're betting on time and compound interest. Preferred stocks are for a different objective. They're for people who have already built wealth and now want the cash flow. They're for people who are closer to retirement. They're for investors who would rather get paid every month than chase stock price appreciation. Here's what happens when you actually own them. Most preferred stocks pay quarterly. Bank of America preferred stock? You get a dividend check every 3 months. Utilities like Duke Energy have preferred shares yielding around 5.8%. Mortgage rights pay preferred shares pushing 7%. These are boring companies doing boring things. But that boring is the point. The risk profile is legitimately lower than common stock. But let's be real, it's not bond level safe either. If interest rates spike, preferred stock prices fall. If the company cuts its dividend, which can happen, your income stream dries up, and your initial investment doesn't grow. So here's the honest framework. Preferred stocks make sense if you have at least 50 grand liquid. You want monthly or quarterly income without touching your principal. And you're comfortable with your money staying relatively flat. If you're 25 and have $3,000, you need growth. You need to be in index funds. You need the S&P 500. Your timeline is too long for income plays. But if you're 40, you've got a solid 401k and Roth IRA already maxed out. And you want to generate passive cash flow from extra money? Preferred stocks deserve serious consideration. The move is simple. Open your Fidelity or Robinhood account. Search for preferred stocks. Maybe look at Bank of America, Wells Fargo, or Realty Income. Check the dividend yield. Understand the terms. And deploy some capital. Start with maybe $5,000 to $10,000. Build your position slowly. Watch those dividend payments hit your account every quarter. That's real money. That's what the wealthy are quietly doing while everyone else is obsessing over meme stocks. This isn't financial advice. Do your own research. But now you know the play exists. If this changed how you think about investing, smash that subscribe button. We're posting new videos about money moves you've actually never heard of every single week. What's your next move? Let me know in the comments.